Now I would like to introduce our final speaker on behalf of JEC Tokyo, who is Mr. Kirk Neureiter. Mr. Neureiter is the president of Fidelity Management and Research in Japan, as well as a portfolio manager in the Japan Equity Division. Today, he is here to talk a little bit about his career in the finance industry, as well as a little bit on savings and the question of why we should invest in equities in the long term. So I'm going to share my screen now, and Mr. Neureiter, I'll hand it over to you.
Great. Thank you. Good evening, everyone. I'm glad to be here with you. I'll talk again. I always think interactive sessions are better than one person speaking at you. And it sounds like you've had a little bit of an introduction to investing in equities. So I'm happy to take your questions later on for that. But just a little bit of my background. I was actually born in Germany, but I'm an American and Irish citizen. Lived in a bunch of different places, mostly due to my father's work. He was in the State Department for the US, and then worked for Texas Instruments, both in France and in Japan. He's part of the reason I'm here today in Japan. I went to high school in Texas, went to university in Ohio in the US, and then moved to Japan right after graduating from college. I had 6 years in Boston after being here for a while, and then moved back to Tokyo 8 years ago to take on my current job. Just switch over to the next page. So when I first got here, I started studying Japanese for the first time. And after a year, I joined Sony Corporation, working in their consumer products division. And at the end, I was actually doing consumer product sales into Far Eastern Russia, which was a really good experience. But it also is part of the reason why I changed industries to Fidelity Japan. I joined as a junior analyst and started covering small caps, hotel sector, textiles, pharmaceuticals, chemicals, and then I became a manager of a Japanese fund. This is for institutional investors. I'll get into that a little bit later, what that is opposed to an individual investor. Then I moved to Boston to work as a global analyst on large cap stocks. And then I moved back to Japan in 2014 to take over the Fidelity Japan Fund, which at the time was about $350 million. Today it's about an $800 million fund. Then a couple of years ago, 3 years ago now, they asked me to manage the Fidelity Pacific Basin Fund, which we invest in stocks from Japan to China to India down to Australia, so the entire Pacific Basin region. So combined, I manage about $1.6 billion out of our office here in Tokyo. I have a group of 7 analysts who are based here who support me on Japanese stocks as well as stocks around the region. And then we have a team of 17 analysts based in Hong Kong who cover both Japanese stocks as well as companies all around the Pacific Basin. If you switch to the next page, please. So a little bit about Fidelity Investments. I believe this group has had a presentation about the asset management industry in the past. Is that the case?
Yes, we had a presentation from a speaker at UBS, Switzerland.
Yes. So Fidelity Investments is one of the largest investors in the world. We're significant players across different asset classes. It was started back in the 1940s by Mr. Ned Johnson, and the Johnson family still owns it. His daughter is now the president and chairman, or his granddaughter is now the president and chairman, a woman by the name of Abby Johnson. So her family and the employees are the main owners of the company. So we manage about $4.5 trillion in assets for 40 million individual customers, and about 23,000 businesses also give us their money to invest for them. And there are 155 investment professionals. Those are analysts and fund managers based in Boston, Tokyo, Hong Kong, and London, trying to identify investment opportunities around the world. And you can see down below there, we have about $2.5 trillion in stocks. $2 trillion of that is in the United States, and $500 billion is invested internationally. I'm based in Japan, and we have about $35 billion invested in the Japanese stock market. We also have bonds, high income, and money market funds, significant assets. Now, you can see down below in summary of what Fidelity does. We're a solution provider. We will give clients what they want in terms of exposure that they want. So I think you heard from Momo earlier about being a conservative investor, and we can provide a solution which is quite conservative. We can put more fixed income in your product. We can put international equity. We can put large cap equity. We can put more money markets in it. What a lot of people want today is a solution instead of just buying a stock or a stock fund or a bond fund. And so Fidelity, because of all our specialties, we're able to package different solutions for people to give them the savings option that's best for them. Because this is something I've always believed throughout my career, which is, I guess I've been at Fidelity since 1994 now, so about 26 years. That when you're investing your own money, what's probably most important is being able to sleep comfortably. When you're young, it's all exciting and challenging, but as you get older, you realize how precious those assets are, and your time starts to diminish as you get older, and your ability to recoup losses also goes down as you get older. So being able to sleep comfortably, knowing what you own, and being able to plan it out over the long term is very important. Why don't we just switch over to the next page? So just quickly on saving. What is saving? Individuals, you're essentially doing it because you're deferring large purchases now for large scale investments or purchases in the future. And if you can't borrow from either your parents or from a bank or from a friend, you have to save yourself to acquire these things. Now, it's even harder to do it when you're just working from a salary. Depending on your income level, tax eats away at your annual income. And in certain tax brackets, you're getting taxed at between 40 and 50%, depending on the country. Some countries have even higher tax rates. But when you're starting out, the big expenditures are furniture, a car, a home. As you get older, college for a child. I'm putting a child through University in the States right now, and that costs $75,000 a year. And that's a big outlay. I started saving for her when she was born. So fortunately, I've got 18 years of investment history when the market was doing extremely well, and her education is paid for. These are some of the big investments that you pay for early on. If you're trying to start a business, you need to start saving early. You also save for emergencies, because you never know when you're going to be sick, you're going to have an accident, job loss. And then last, as you get older and older, retirement. If you're going to stop your job, if you want to retire early at 40, if you want to retire early at 35, you got to start saving now, because every year you're going to require that money to be able to live. Now, after individuals, you look at companies, why they save. What are they doing? They need to save if they can't borrow enough to expand production of whatever they make, whatever service they provide. They need to save if they're going to try and make an acquisition of a competitor. They need to save if they're going to try and buy back their own stock, or they need to pay out retirement benefits to older employees. There's another group, charities or nonprofits. These are things like hospitals or churches or charitable groups, say for the homeless. Many different charitable institutions. People give them money and they can't spend that money all at once, and so they build up these funds to invest and earn money for them to pay out benefits in the future. These are big clients of ours, and it's essential that they be able to earn money on that retained earnings. So how do you expand that pool of savings? And really, investing is the only way to generate returns greater than, and hopefully the most important, depleter of savings, and that happens to be inflation. So, when you go through all the options, the most important thing is that your investment is that you're able to manage the risk first, but then being able to beat inflation over the long term is the second most important thing. Let's switch over to the next page. So as I mentioned, you got to use the power of the market and others to work for you to beat inflation. You are racing against the loss of purchasing power because of inflation. Now I'm going to go back a little bit further in time. So over 50 years, inflation has averaged between 3 and 4%. We've had a really nice period here over the past 10 years or so, where interest rates and inflation in the United States and globally has gone down a lot, and it's led to a lot of appreciation of markets because interest rates were so low. But now we're starting to see that change a little bit, and prices, first off, in the United States, are running between 7 to 8% on an annualized basis. That's the CPI. That's a Consumer Price Index. Now, part of the reason that the US is at the forefront of this is because they've been recovering a little bit faster than the rest of the world from Corona. And so the economy's been accelerating, and there's a lot of money in the system because of the stimulus provided by the central governments. Now that inflation that we've seen in the United States is starting to spread into Europe. You're seeing a lot of energy price inflation, and that's going to flow through to other parts of the economy. When you start to see the CPI appreciating too quickly, interest rates are going to start up, and your purchasing power is starting to be depleted unless you can invest at rates which exceed the rate of inflation. So for investing, let's go through your options. First, you can stick any money that you've saved under your mattress. This was an extremely popular strategy in Japan because they were so fearful of the markets or putting in any place else when the bubble popped in 1990. But you get zero return. You're going to lose over the long term 3 to 4% of your purchasing power. Just an example of the things that go up over time. So when I was in high school, price of gasoline was about 75 cents. Prices now are in excess of $4. A can of Coca-Cola was 35 cents. Now in the United States, most Coke machines will sell at around $1.25. So if I had had $1 sitting under my mattress for the last 30 years or 40 years, I'd only I wouldn't be able to buy one can of Coke, whereas I was able to buy 2.5 in the past. You can deposit in the bank at some interest rate, but that's generally less than the rate of inflation. It's very, very low risk. Very low rate of return as a result. You can buy foreign currency for a higher interest rate, but there's greater risk of it depreciating against your own currency. Now, the second one I mentioned here is crypto. Crypto is a really hard one to talk about because there's very limited history in crypto. So it's really hard to say if this is investment, a store of wealth, or it's speculation. And I'm sure everybody has an opinion about it, and I'm sure people are making money on it because the price keeps going up. But I've never heard anyone be able to really tell me what's it worth. They always say, well, then more people are going to buy it, so it's going to go up. Unfortunately, there's a ton of different cryptocurrencies out there, and more keep coming. Obviously, Bitcoin and Ethereum are probably the most well known. But it's really hard to say where it's going to be in a period of 5-10 years, and that's how you really measure sort of the durability of your investments and try and predict what rate of return. And so perhaps holding a percentage of any asset you have in crypto is one idea if you care to speculate, but it's really hard to predict what that might be worth at some point in the future. Maybe a basket of cryptocurrencies is one way to get exposure. Another one is gold. Which is always perceived as the currency of last resort because everyone will accept it. Every country in the world, they used to base their currencies off of, but it moved away from that and more towards fiat currencies. But it's very tradable. There are high costs of exchange, so it's not great, but it doesn't generate anything. It just sits there. Warren Buffett, if you've heard of him, he said one great thing about gold. What if you bought up every piece of gold in the world and you melted it all into one giant block? What would you do with it? You'd have to hire a bunch of guards. You'd put it in a gigantic vault and you'd sit there and look at it. But nobody else would be able to buy it off you because they couldn't afford it. and it wouldn't generate anything for you. So it's, again, it's sort of speculative in a sense that at some point it will be tradable, and a lot of central banks own a lot of it, but it's hard to say what it's really worth. Some of the things like collectibles, these are, jewels, art, wine, etc. Everybody says, oh, they're such great, but there's a lot of friction costs when you put it at auction to sell it. You have to pay big commissions on it. So unless you hold it over a very long time, it's very hard to recover those costs. Bonds, they're very liquid, very easy to trade, but the rate of returns are, if the high yield bonds can get you 6 to 7%, but they're more risky because their potential bankruptcy of the company is higher. But government bonds, longer term government bonds, around 4%, and short term bonds are between 1 and 2%. So again, you're still battling against inflation, especially when CPI is at 8% currently. Property, it generates some rental yield, and there is some speculative element to it when things get great, but it's more like a bond than it is an equity. And lastly, stocks or equities. What's great about equities is that when you buy something, you're buying a piece of a company. And a company is something that has the potential to earn significant rates of return if you're choosing the right one. It also has the ability to grow, something that a bond doesn't do. It just pays you out a certain amount of interest and never grows. The principal never grows. With equities, $100 investment in a stock, that will grow. Let's say it grows at 10%. The following year, if it grows at 10%, it's growing on a base of 110. And that continues to compound over time. And when you think about the potential of a long-term growth over time, long-term growth company over time, and the ability for those earnings per share to grow up and the value per share to go up, it's just massive, the potential, if you get your investment right. So this is one of the reasons why I've always found equities to be the most profitable investment over the long term. Let's go to Aisha, how are we doing on time? I just want to be conscious of everybody's time. Are we on schedule? I've got about 8 more slides, and I can get through them relatively quickly if we're tight on time.
Yes, no, that shouldn't be a problem. Arnis, we should be good
Okay.
on, correct?
We're on time. We're definitely
Okay.
on time.
Perfect.
Great.
Should I move on to
All
the
right, so
next?
please go over to the next slide. So this is a comparison of returns of different asset classes over time. And can anyone read the starting date on that? It's too small for me at this point, and I can't explain it.
1988.
So 1988, this is a relatively short-term history for most people when you go back and think of things, but I'll show you some different statistics later on. But equities by far and away have been the best performing asset over time. So the equity line, this is US large stocks, the S&P 500 in the black on top. I believe long-term government bonds are the second line in red. International stocks are the third line in blue. Real estate is in purple, and gold, I believe, is gold. And then the green is short-term treasury bills. And then the last gray dotted line is the rate of inflation. So this is just one statistic highlighting how far superior the equities have been to the other asset classes that I was discussing. Again, crypto has seen phenomenal returns. When I lived in Boston, there were ATMs at the train station downtown where I could have bought Bitcoin for around $75. All I had to do was put my credit card into the machine, and here we are at what $43,000, I think, for a Bitcoin today. So I've been accused of being stupid by my son, and I put my hand up, but I just didn't know what it was worth, and so I tend to be a little more thoughtful rather than just putting out there, because I think someone else is going to spend more money. So I'm still studying it. I've been studying for a long time, and I still don't 100% get it, but I'm trying to get my hands around it. Let's switch over to the next slide. So what's really important to understand about stocks is the value of those stocks tend to rise with the earnings that they generate. So the line on top is the market average, I believe the S&P 500. The middle line are the earnings of all of the companies in the S&P 500. And then the line down at the bottom is the valuation, what the price to earnings that you're paying over time. And then on the right-hand side, you can see this is between 1900 and 2020. These are the long-term returns of the stock market. So over all periods on a monthly basis, market average has gone up by 80 basis points or 0.8% a month. During bull markets, up by 1.5%. And then during bear markets, this is when it's been down over a significant period, typically 2 quarters in a row. They still go up, but only by 0.3%. And you can see the annualized change below that, 10.2%. And then during bull markets, when you're seeing multiple expansion, it's up by 19.5%. But again, look at the statistics down below. By buying and holding over a longer period, on average, you're going to be up every single year, even when you're in a period of weak markets. So that's how compelling owning stocks over the long term is. Let's go over to the next page. One of the reasons why stocks are so compelling is that they continuously generate a free cash flow yield. So the S&P, the line on the top is the total return. The black line on the bottom is the free cash flow yield. This is the free cash flow divided by the market cap of the company. And you can see that broken down between dividend and stock buyback below in terms of how they're returning that free cash flow to shareholders. So you're at certain times, as you can see in 2009, during the Lehman shock, when the markets collapsed, the free cash flow yield was significant, and it made it a really attractive time to buy stocks because they were so cheap. And you've seen very big multiple expansion since then, with the free cash flow yield going from 11.5% down to 4.3%. But they're still yielding in excess of most other investments, which makes them still pretty compelling. Go to the next page, please. This is the yield of what you're getting on different government securities. So you can see how that has been coming down over time as well. This goes back a long time in history, since 1928. Interest rates spiked quite a bit in the late 70s and early 80s, when we saw quite a bit of inflation. And the chairman of the Fed at the time raised interest rates significantly to knock back inflation. They've been falling ever since. And that's why equity investments have been so powerful, because if you're familiar with discounted cash flow, as you lower your interest rate hurdles, the value of stocks go up significantly. The value of free cash flow being generated by companies goes up significantly, so the share prices are worth that much more. So it's been a great time to be an equity investor in the past. Let's go to the next page. Now, I'm going to talk a little bit more about stock picking at an individual level. So I'm a growth investor, and these are the things I look for when investing in a company. First, I try and understand their product or service. What is the barrier to entry to that product? What is its competitive advantage? Are they growing their customer numbers? Are they able to raise prices? If their product is so good, certainly they can charge a higher price. If their prices aren't going up, why not? And what's happening to their profit margins? Secondly, I try and look at what the potential market size, or it's called a TAM, total addressable market. So what market share does a company have today? So let's take a company, for example, hopefully some of you know, a company like McDonald's. They might have 20% of the fast food market share in the world. Can they go to 30%? Can they go to 40%? Or are they at 20% today, and are the competitors getting tougher and tougher, and they're only going to be at 20% 5 years down the road? How fast can that grow, depending on how much market share they can take? So understanding what the potential is for a company to grow and how fast that potential is. Because my goal as a growth, I'm trying to understand how much profit this company will earn in the future, whether it be 3 years or 5 years. And then I try and decide what's the right price for that company. The next thing on the list is their profit margin. How much profit can they earn for every $10 of sales that they generate? Is it $1? Is it $3? Is it $5? With software companies, it can be very, very profitable because all you have to do is have a programmer who writes some software, and you can sell that at $100. So it's just your cost of your employee and maybe a couple of laptops and possibly a server. But if you have to make a factory and you have to manufacture, you have to buy cost of goods, you have to buy a lot of raw materials to make what you're trying to sell, that can be different. And if competitors enter your market, it can push down prices and it can affect your profit margins, which affects the value of the company. Next is what's your return on equity, or your return on the amount of money you invested to start your business. So what is it today and what is the potential? It's always important to understand that the value of a stock can change dramatically if the return on equity can rise over time. Because as an investor, you're investing in the equity. So if they earn 10% on that equity today, but earn 20% on it in the future, then it becomes a lot more valuable to you as the owner of that company. Last two things I want to talk about: your management quality. Is the management team also owners of their business? Do they own the stock in the company? And what are their goals? Are they trying to raise the share price, which is exactly what you want to do as an owner of the company? Many times you can see companies or company presidents, they list their company, they get rich quick. They really lose their desire to push the company ahead, looking toward the future, really taking it to be bigger and more valuable. And that's something we do when we visit with management, to really try to understand what their motivation is. Lastly, valuation. It's really important to understand how the company is valued, both versus itself, how did it trade in the past, and how it's trading versus its peer group, what its competitors are trading at, and then to try and forecast how much this company will earn per share in the future. Because sometimes it could be earning $1, but they're coming out with a new product that could really drive sales through the roof. Take for example, an Apple iPhone. They come up with the next generation of iPhone, and they put an attachable on it, and they introduce the iWatch at the same time. Earnings per share can go up by 30-40%. It becomes a significantly more valuable stock over a 3 to 5 year period. So understanding what's going to change in the future, how is that going to impact earnings per share? Those are some of the things I look for as an investor. Flip over to the next page. Just a couple of examples. The first one is Google. You can see over time since 2012, I think the green line is the share price, the white line is the earnings per share. And can any of you venture to guess what's driven earnings per share over the last couple of years when you've seen it really tick up? Any thoughts? I don't want to waste time, so I'll give you a hint. So Corona drove a ton of people online, and online advertisements really picked up. So Google, through Google search, is essentially the biggest online advertising platform in the world. The second thing that's really taken off is YouTube. So YouTube has become a massive advertising venue for Google as well. So earnings has really picked up, and you can see the share price has gone right up with it. The next example is on the next slide. This company is Boeing. So things were going really quite well from 2012 until 2018. And then two things happened. First, which you all know about, is Corona, which decimated both domestic and international travel and demand for airplanes as a result. And so if nobody's buying new aircraft, Boeing's business and earnings, which is the white line, fell through the floor. They were earning $15 a share, and it dropped down to negative in the last year. The other thing they had was some issues with the 737 MAX, where two deadly crashes happened. This was a big launch of a new product for them, which was really supposed to help earnings, but there were issues with the design of the plane and the software associated with preventing crashes. Unfortunately, two big crashes and a substantial loss of life and a lot of reputational damage to the company. And as a result, earnings have gone through the floor, and you can see what happened to the share price. It's fallen from $450 to less than $200 today. So this is just another example of how share prices move with earnings, and trying to understand what the impact of incidents are on those earnings. How can it impact your investments? So last slide, I believe I have, are the 3 books that I was talking about at the end of Moma's presentation. These are 3 really good books that I'd recommend for anyone. They might be a little bit dated right now, but the first one, Stocks for the Long Run. Jeremy Siegel is a very famous business school professor at Columbia University in New York. It's really about long-term growth stocks. Very, very well-written book. One of the best books I read. Common Stocks, Uncommon Profits by Philip Fisher is also very, very well-written book. A lot of very thoughtful points. And the last one, Peter Lynch is from Fidelity Investments, and he helps simplify the investing process and really makes it easy to understand in terms of what stocks are, what owning a piece of a business is, but also really studying what you're buying, so you know what is going on with your investment, and you have faith that this company is going to perform like you want it to. So there's some really good lessons in all 3 books, and I highly recommend them. With that, that concludes my presentation. I'm happy to take questions.
I ask a question, like, do you encourage like for us senior high school student being a speculator for play the invest for short term?
Absolutely not. That's exactly what I was trying to tell you. No, because it's very hard to predict what's going to happen in the short term. And if you can do it consistently, you're amazing. I've got no idea what you're doing, but great. Good luck to you. One thing I do have faith is my ability to invest over the long term, picking stocks that are generating good returns, have good products that grow over time. One of the things that I put in place over a long time is, what products are my kids really using a lot of? So some of the stocks I bought over time are Nike, Disney, and essentially they've paid for a lot of the products that I was buying for my kids. Because they were using so much of these products, and all their friends were talking about them. And, here we are signed up for Disney Plus now. They're still buying Disney or Nike shoes. So understanding what you're buying and having a strategy for generating returns from these assets is really important. With short term, there's a lot of transaction costs associated with short term. You have to pay short term taxes on it. Tax rates on short term investments are higher. So it deteriorates your total returns. So it's just harder, and the frictional costs are higher.
Okay, thank you.
Yep.
I have a question. So earlier on in your presentation, you talked a little bit about how you had been saving for 18 years for your daughter's kind of education and how that was beneficial.
Yep.
As a
Yep.
high schooler, I think most of us are in the range of like 16 to 18. What would you
Yep.
recommend we start doing at this age in terms of savings for our future?
Well, that should have been done by your parents, not by you. Because one, you're not a very thoughtful investor. So, so I don't know what advice I give to your parents right now, but what you can do is certainly learn about investing. And I don't know, again, it depends on your nationality, what you're able to do in your particular country about being able to open up an investment account. Certainly your parents, if you're an American, they have educational savings accounts. If you're a Japanese, there are educational saving accounts called NISAs that they can open up on your behalf, and you can help choose what investments they can make for you. In NISAs in Japan, you can buy individual stocks, you can buy funds. But getting started early in your investing career, as I said early on, all of us are battling against time. And I guess the faster you start, the brighter the future is.
Thank you.
Sure.
I have a question. Previously, you compared various types of of investment opportunities such as stocks, cryptos, gold, and one of the things you mentioned are bonds, and you said that they typically tend to have a 6-7% return rate, or they can be even.
No. So the 6 to 7% are sort of high yield bonds, and those are higher risk bonds, typically corporate bonds.
Corporate bonds, yes. What I wanted to ask specifically are the war bonds that were issued by Ukraine at a return rate of 11%, and they managed to raise almost 300 million, I think. Do you think that that's an investment that's worth the risk for the yield that it provides?
Really difficult question to ask because you're having to gauge the sustainability, their ability to repay you as an investor. Now, there are so many questions that go into that answer that me being a specialist in Japanese stocks is not capable of answering, because obviously they're receiving a ton of support, but they're also under attack from a very powerful army that continues to encroach upon them and is destroying their infrastructure day by day. So if something happens to the government, if something happens to the infrastructure and affects their inability to pay, those bonds become worthless. So that's something for you to decide, and you have to determine that risk. I'm not in a position to say.
Okay, thank you.
Yeah. Anything else?
I have a question. What sort of like subjects or internships would you recommend taking if you want to go into like this sort of world? Like,
sure, good question. So one of the things that we look at Fidelity is whether or not an individual has had investment experience themselves. So I highly encourage you to start understanding the stock market, understanding the world of investments, and it's great to see that you're involved in this club. Reading there's so many smart people in this industry, so many books have been written on the investment business that there's a lot of material out there. And so I highly encourage you to do some reading to get familiarize yourself with that. If you can get internships in investment companies, in banks, to better understand the world of finance, it's incredibly valuable, both for your own understanding as well as for potential job opportunities. So my company, we're hiring an undergraduate intern from a Japanese university this year. I know a number of other companies around town that are looking to hire interns as well. It's a great opportunity for you to learn about the company as well as the company to learn about you, to possibly invest in you in the future, potentially hire you for a job. The biggest and best thing you can do, if you can find that opportunity, it's hard. It's a little bit easier as you move further down your educational experience, up in your experience level in higher education. But if you can grasp an opportunity some way, it would be immensely beneficial for you in the future.
thank you.
Sure.
I have a question.
Yes.
Previously, you talked about how, for example, a crisis like a COVID-19 affected a company like a Google, and or a possible future crisis is invasion of Ukraine. So what do you think about which companies or type of companies or sectors will be affected positively by this crisis?
It's really difficult to say, but we've seen some of the impacts in the commodity markets. Things such as, again, it's interesting because Aisha asked me initially to talk about how sanctions would affect the investment world. And sanctions that are being put on Russia by much of the Western world are affecting markets in many different ways. And it's affecting transport, affecting air travel. Airplanes that used to fly over Russia to get into Europe are being impacted. Many of the commodity markets. So Russia is a big supplier of oil and natural gas to both Europe as well as Asia. And prices of those things are rising significantly. So it's benefiting those companies that hold those resources, that are producing oil, but don't have any exposure to Russia or Europe. So one example is a company in Japan that produces oil both in Indonesia as well as in Australia, and they're benefiting from much higher prices, but they don't sell to any dangerous region. So they're benefiting immensely because of the spike in prices. Same with the big US oil companies, because they hold these resources in safe areas, whether it be in the United States or in the Middle East, and it's totally out of Ukraine or Russia. They have no exposure there. So again, this will change over time. Again, the situation in Ukraine is absolutely disaster, human tragedy, but it's affecting markets in different ways, and that will change over time depending on how it plays out, which, again, it's a terrible thing.
Thanks.
Anything else?
Okay, well, if there are no other questions, Mr. Neureiter, thank you so much for coming to speak with us. It was really informative, and we have a lot
Great.
to learn from that. Thank you
Great.
so much.
Let me know if there's anything else I can do. Appreciate
Thank
it.
you.
All right. Bye-bye.
Thank you.
Thank you.
Thank you. Bye.
Thank you.
Okay, with that, should we conclude? Okay. With that, we would like to conclude the 2022 International Forum. Thank you so much, everyone, for attending and staying engaged. Hopefully, we have a lot to learn from our speakers today, and we can apply what we learned to our future, and hopefully it increased our interest in the finance industry a little bit. Thank you.
Thank you.
Thank you very
Thank you,
much.
everyone.
Thank you very much, everyone.
Thank you.
I have a question.
Thanks.
Uh,
Thank you.